Hello everyone, and welcome to this webinar. I can't really say it's afternoon, evening. Well, it's sort of early evening here in the UK, but I know a lot of you are joining us from North America, where it's probably about lunchtime. But wherever you are in the world, thank you so much for taking the time out of your day to come and spend some time with David and myself. David is sitting behind me, and in this session, well, we've got lots and lots of goodies for you in this session, actually. There's quite a lot going on that we want to cover. And, you know, as I said, a bit of education. Obviously, we're going to look at some charts. And we've amalgamated the two sessions where we used to do the futures, the indices, and then stocks, but we're actually going to put it all together because it's just easier for us. And you know, so you can sort of, if you want us to stay on for the first half, then that's fine. But as I said, we're going to cover the indices first, a bit of general first, then the indices, and then we're going to look a bit more in detail at stocks. But before we start, as always, can I draw your attention to the disclaimer that I know you can see on your screen? As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And just for this, some of you I know are first time coming to one of our sessions. We're obviously going to look at the markets and we're going to look at charts, but we look at the charts through the perspective of what we call volume price analysis, and that is the price action and the volume. There are other elements to VPA, and we'll explain those as we go along. But the basic concepts of this methodology you can find on this book, which is on Amazon, and it's the relationship between, as I said, the price action and the volume. Volume actually, it leads the market in the sense that it's participation, it's the buying and the selling, and what you're looking at is whether the price action that you're seeing, if the price is going up, is it actually being supported by participation and activity, and when it isn't, it's what we call an anomaly, and we know that it's either going to be a trap or the move has come to a point of exhaustion. Essentially, it really gives you an insight of where the market is going next, which is really that's all we want to know. What we've done as well is we have come up with a companion book with some examples of how you can recognize they're not so much signals. I don't really want to use that expression of VPA. They are setups, if you want to, a better explanation. It's really seeing the concepts on the charts in all sorts of different time frames. This is particularly for indices and stocks, and there's also one for the Forex market as well. Now, when I said earlier that VPA, we've got the volume, we've got the price, we use candles and candle patterns, and we use, obviously everyone uses support and resistance, but it is actually a crucial part of the VPA methodology. But it is support and resistance, not just price-based support and resistance, but also volume-based support and resistance. And we've developed, we have one indicator in particular that we use for that, which is the volume point of control. But we are also looking at others to develop, to to put into our arsenal of volume indicators. Now, once you've got the concepts of VPA, you can look at a chart, you know what you're looking at. You can then add on other indicators. You can use standard indicators, moving averages, you use Bollinger Bands, you can use MACD, Fibonacci. That's fine, absolutely fine. What VPA will tell you, will reveal to you, is which of those indicators will actually work in the kind of chart shape, if you like, that you're looking at. So you start with being able to read the chart, then you can apply the indicators, and you apply and read the indicators that reveal, that help you with with reading the chart. So just to give you a very simple example, moving averages. Moving averages are fantastic. Everybody uses them, the media refers to them, etc., etc. But they are great when markets are trending, but when they're in congestion, they are very frustrating because they simply sort of curl around each other if you use more than one. Now, a lot of, that may seem obvious to you, but I can assure you a lot of traders aren't aware of that. They maybe have a strategy, a tactic using moving averages, and they often wonder, well, why did it work then and it doesn't work now? And that's simply because they're being used inappropriately, as it were. Part of VPA is being able to recognize the shape of the chart, the market mood, if you like. What is the price action and volume telling us? Are we in a trend? Are we in a congestion? Are we in a primary trend? Are we in a secondary trend, etc., etc. We've actually developed proprietary indicators. I don't have any standard ones on my charts. I mean, occasionally I do use moving averages, and then overriding that we have time. That's time of the chart that we are trading, but also in multiple time frames. In other words, you look at more than one time frame when you are looking to take a trade, and we'll talk about that in a little bit more detail when we look at some very specific well, I've got some very specific stocks, David has, but also with the indices, and you can see his set up on his machine. Now, I have today, I've actually got Ninja, I've got MT4, and I've also got Trading View, and I've got investing.com. So the first thing, just very, very quickly, let's have a look at sort of overall sentiment to see what the markets are doing in general. We can see the futures are up slightly. That's the US 30, that's the Dow Jones futures, the S&P 500, they're up, but it's quite a quiet day at the moment. They're certainly not roaring up, but neither are they falling out of bed. And this is the NASDAQ. And what I said about looking at a chart shape, this is the daily chart. What is the first thing that you notice about this chart? What has been happening over the preceding sessions? Well, essentially, the NQ, as we can see here, is in, it's almost like what we call a washing line. Range has been very narrow. It lacks a firm direction. Is it going to fall? Is it actually going to make another run at the all-time high? We just don't know at the moment. If you looked at that, I think it probably tells you that if you're trying to day trade an instrument that is displaying this kind of price action, or has been over the last few sessions, and the very narrow range that you are in at the moment, it's going to be very, very tricky, and the chances are it's you might be able to snick a few points, but that's just about it if you're lucky, and maybe even a lot of choppiness down at on the faster time frames. Whereas you compare it to let's have a look at this. When you have a nice steady trend higher, it's up, up, up. You've got some days when you've got some pullbacks and what have you, and then you look at the volume to see whether in fact there is a reversal or is simply a pause point before the trend carries on higher, and then we go into a congestion phase again, and down we go. We are in one of these congestion phases. The difference this time is that it is very, very narrow. Now, there's all sorts of reasons for that. Let me just put a chart up, which is a bit more interesting to look at. Let's have a look. I've got the YM here at the moment. Right, this is the sort of education bit. Basically, as I said, markets are uncertain anyway, but there's even more uncertainty than usual. And one of the reasons is inflation. Do we have inflation? Do we not have inflation? How is inflation measured? There's all sorts of questions. There's a huge narrative around it at the moment. Now, depending who you read, if you listen to what the Feds say and what the central banks say, well, yes, there is clearly inflation because prices are going up. They accept that, but not by their metrics. What they're saying is it's transitory, and they don't include the kind of day-to-day expenditure which you and I have to know about. The things like food, commodities are going up. If you've come to our previous sessions, we'll see when we've looked at soybean, wheat, oil, the things that affect us on a daily basis, they have been going up. And if you go over to my blog, annacooling.com, we actually did a post on soybean, which has been in a fantastic run up. We had a bit of a pullback. It looks sort of bullish again. Now, okay, you say, well, soybean, you may not eat soya, you may not drink soya milk, but soya has all sorts of other functions in the food chain. If that goes up, food prices go up. Commodities are rising generally because markets, traders and investors are looking for a return, and a lot of money has gone into commodities because, you know, in a low interest environment, that's what traders and investors want. They want a return on their money. And what's happened when you have this low interest environment, you know, people have gone into sort of riskier assets because they promise greater returns. Now, that's on the kind of inflation, you know, is it going to go up? You know, are we looking at, you know, big increases in the coming months and sort of year or so? The other thing that drives inflation is wages. So when we're looking at the fundamental news, everyone's paying attention to the non-farm payrolls, anything to do with labor costs and, you know, job creation, as it were. And I think wages have been going up because, you know, when prices go up, people want more money because they need more money for their day-to-day living. The issue at the moment with wages is that may be true, but there's also a lot of people still unemployed from the result of the pandemic, because one of the drivers of inflation is higher wages. Now, they may ask for higher wages, they may not necessarily get it because there are people, you know, employers could turn around and say, well, okay, if you're not happy with this wage, you go, you know, there's maybe 3 other people who are willing to take the job at a lower rate. What that happens is when wages don't rise, and there's so what you could have is you could have deflation, which I know sounds counterintuitive because you think, well, hold on, everything's going up, and now you're saying actually we're going to get deflation. Well, it can happen, and the other reason why there are some commentators who are saying this inflation narrative is just a bit overdone, as it were. And that is something called the velocity of money. And this is not going to turn into an economics lecture, but it's just something to be aware of. The velocity of money is essentially when money is in an economy and it's being, you know, handled and it's being turned over, as it were. So $1, you know, it's the speed at which that $1 is turned over in an economy. When that slows down, and it's not being turned over, there isn't any inflation, there's no demand. So if there's no demand, if you as a producer, or you know, you sell services or what have you, and there's no demand, what do? You lower your prices, and lowering prices is not inflationary, it could potentially be deflationary. So this inflation narrative is interesting, but there is another side to it. You may not read a lot about it, but just be aware. Now, how does that impact the markets? It throws more uncertainty into the markets, and that is what we are seeing at the moment. And what we need to, as a trader, as an investor, you have certain issues, certain, you know, concerns that you are going to have to, you know, where do you put your money? Markets are at almost, you know, if not at all-time highs, but approaching that. Do you want to go in at a top? Is it a top? You know, it's very, very difficult to be an investor at the moment. For a trader, the issue is, in a way, you don't care. What you want to capture is that moment when, you know, yes, it's going to shoot higher. You're going to be on, you know, the bullish side, and if it's going to roll over, you want to be on the, you know, the short side, basically. And this is where you go to your charts. You look at, this is, as I said, this is my YM. This is my 5-chart setup that I have on MT4. It allows you to trade an instrument like the Dow futures, but not the actual futures itself, which is absolutely fine. And I have the daily chart, I've got the hour, I've got the 15, I've got the 5, and I've actually got a Renko. And this is what we talk about multiple time frames, although strictly speaking, a Renko hasn't got a time frame. It's a non-time based chart. It's simply the chart that one of these bricks is displayed, produced once a certain number of points actually goes through the market. And you simply look at it from the perspective of where am I going to find a good entry based on what am I seeing in terms of a price action? What am I seeing in terms of volume? What am I looking at in terms of support and resistance? And this is where I use the price-based resistance is the Camarilla, which is these levels here. The third level is hugely important. It's where prices have a habit of turning over. I look at the daily chart to give me a view of, well, what has the Dow kind of been doing? It's kind of been in a trend, but it's sort of now moving. As you can see here, we've had some sessions. Once it broke away from the volume point of control, it's kind of moving sideways. The volume is kind of falling away. It had a big wick to the top of yesterday's candle. So is it any surprise to see that that weakness has sort of translated to today? So is the bias to, is the short side? It looks like a little sort of doji. It's, as I said, dojis are indecision. If you get a big doji, it's a lot of indecision. So you have to go back to the faster time frames and look for the potential entries. And certainly the potential entry from this is the kind of choppy price action that we see. It's really quite horrible. It's a reflection of what is going on the daily chart, where we have this indecision and also the market indecision. But it looks like it's really setting up for quite a nice move off the R3 level. And what I really like is I like to see a combination of a positive correlation between the trend dot, which we have here, and the trend monitor. Now, the next question is, right, well, we've seen that a break from the R3. It actually also came off the R3 on the hour. If we look at the 5-minute chart, what have we had? Well, this is the open. Obviously, we have the usual volatility down, then some up, then back to the volume point of control. This kind of move higher. It's the worst of all worlds. You've got a bit of a trend, then a consolidation, then a bit more of what could be a trend before you got this reversal off. It's I couldn't even call it a shooting star. It's really the open kind of settling down before we get some firm direction back to test the volume point of control. And I would have said here, based on what we see on the Renko chart, this would be a good point of entry. What the Renko does, it keeps you through these situations where you do have buying coming in. There are orders littered on the YM and all these indices where there are standing orders there where the buyers have obviously come in to sort of support the price. Not a huge. What you then look at, you think, well, is the volume enough to push that higher? Well, it certainly pushed it a little way, but the candles to look at, when I said about this is now the primary trend lower, is these candles that come in on a pullback, and you look at that and you look at the volume, and is that going to be enough to actually reverse that? Well, clearly it isn't, because that's lower than that one. That's a very squashed candle, so it's an anomaly. And then the down move carries on. Now, where is this likely to be going to? The obvious price objective is actually down here at the open, where we've got some support. Both we've got some price-based support and we've got some volume-based support. So looking at that piece of price action in the context of the Renko, this is the little pullback that we have here. As I said in the webinar this morning, and when I personally use the Renko, and this is just a suggestion, it's not, I'm not saying you should do this, but consider this, is certainly use it for entries. It's great for entries. It's great for keeping you in. It absorbs all that volatility. You get a really nice move lower. If I just make that, there we are, you can see it a little bit better. It absorbs that move lower. The levels then come in to tell you where the S1 is actually the level, is the level that we see on the time chart. That is where it's logically heading to. But what I would do for an actual exit, as it were, I would be minded to use the time chart more. Personally, I like to use it for entries, helping to keep stay in, and then look at the time chart for a potential exit, as it were. So that's on the YM. This is my index. This is, you know, it's one that David has always ever since, well, we started off with the FTSE futures, but the YM is the one that we've focused on the most, which in a way, the futures of the Dow is probably, you know, it's only 30 stocks in the Dow. It really doesn't represent what is going on in the broader economy. And I'm actually going to talk about after David's his contribution, I'm going to look at today more to do with stocks, having a look at the Russell 2000 for an insight into market sentiment, into what is going on behind the scenes, as it were. And there's lots of reasons for that. We've never really not really looked at the Russell at all. We admit we tend to focus on the Dow, the Nasdaq, and the S&P. Those are the ones that, you know, a lot of traders look at. But the Russell, and not the Russell 3000, the Russell 2000 in particular, has some really interesting aspects to it, which I think can, you know, can give you some additional insight into basically market sentiment and risk. So that's my YM, that's my Dow. I don't know whether David has got the Dow up, or he may have the NQ. I'm going to pass over to him. If you've got any questions, then please just drop them into the chat box, and after if we come back, we'll look at stocks in more detail. I also want to talk about market liquidity, which is actually really important when it comes to selecting stocks. And I have at last, I think, put together, a really nice little methodology, if you like, of searching for stocks using a couple of the free sites that I've mentioned before. One of them is FinViz and one of them is MarketBeat, and we'll do that in the second part of the session.
Hi everybody, yeah, can do a bit. Hi everyone, sorry, I just adjust my microphone. Hopefully you can hear me okay, hopefully you can see my screen. Just turn around. Yep, you can, brilliant. Lovely. Just to, in fact, let me start with TradingView. Let me just pull this over. Really just to get a fix on where we are. This is on the 4 indices, so this is the 4 currency indices. I've got the pound on the left, which is probably least relevant to this conversation at any rate. The yen index, which is certainly directly relevant, as is this one, the dollar index, and over on the right we've got the euro index. So basically the two that are of direct interest are obviously the yen and the dollar. And let's just pop that up full size, see where we've been going all day. Pretty much, you know, what has been reflected in terms of both the price action on Globex and now with the cash markets open as well. It's very febrile, it's fragile, it's indecisive, and you're seeing that on the yen index. This has spiked up, and that's the reason, part of the reason that you're actually seeing the spike down in terms of the indices. And the dollar also, the dollar's been, it was very strong this morning, had a strong run up. It's come off quite a bit this afternoon, but is now starting to rebase and perhaps recover as well. So if we've got the dollar rising and the yen rising, not exactly going to be great for indices intraday at any rate. Just move that back out of the way. So that's where we are in terms of indices. Keep an eye on that. The VIX is trading at around 19.5 at the moment. Still hasn't got down to Never really got down to the figures of last year or the year before, where we were trading around 10, even dipped below that into single figures at one point, I think 9.5. So we've never ever got down there. We've been trading around mid-20s, high 20s for an awful long time, and now we're trading around just below 20 at the moment. This is on the VIX, sorry, this is on the NQ. This is on TradeStation. This is basically TradeStation driven by one of our interactive brokers accounts. So that is linked directly through to the TradeStation interface. It's called TradeStation Global. And it means I can trade straight off the screen here. Don't have to go anywhere else. It's all dynamically linked. It's just a great way of having the TradeStation, the TradeStation charting application, and the advantages of trading through a deep discount brokerage like Interactive Brokers, who are phenomenally cheap, and will also, you have access to all the markets you could possibly want or think of. Basically up here on the left hand side, I've got the radar screen linked to this one. So we've got symbol link and interval link here, symbol link and interval link here as well. So I can click through any of these. I've got 1, 2, 3 right the way through to the dailies, weeklies and monthlies. And then on the 2 radar screen channels that I've got up, in fact, I've got 3 here. I've got the volatility index over here. So that tells me how many bars ago we had a volatility trigger. We've got the quantum trends indicator, which is the dots, and we've got the trend monitor here as well. And it just gives you a complete visual picture. You can just scroll through, just change the time frame over there, get that out of the way. And through you go to, we're now on the 3-minute time frame. You can see the trend monitor. It's been pretty bearish. We've had this rally. We had the volume falling away. You know, it didn't look great. There was really very little effort going into that rally. And now we've got rolled over. We've got this price waterfall. We've got a big volatility trigger, 1.5 tons of volume under it, which is what we expect to see. Got some buying coming in here, a little bit of more buying coming in here as well. The market is going to try and rally. The trend monitor is red. So we're going to see a bit of a bounce coming along, just seeing what's going on in terms of the yen still climbing. Excuse me, the dollar's come off a little bit. Just see if this is going to hold. And down here on the left-hand side, I've got the time and sales. This is not fictitious orders. This is not a ladder where you've got spoofing going on. These are real executed orders going through the market live. There was one went through, I think it was around on this bar. There was a block of 100 went through here, immediately caught my attention. And it went through below the bid, I think, from memory. It just catches your eye. That's what you're looking for. You're looking for a reaction to the market. I'm not interested in these 1s and 2s. They're just noise level. You know, they're not going to move the market per se. What you're looking for is big double-figure numbers or 3-figure numbers going through, and then watching the consequent reaction in the market, how it reacts to that weight of pressure of volume, of order volume that has gone through. But I stress the point, these are executed orders. These are not pending orders or limit orders or any. There's 147 gone through there, just gone through above the ask. Just want to see what happens in terms of the market. So there's 147 cards. One person or one company or one individual has just put 147 orders through in one lump. Do you want to see how the market reacts? You should expect to see it jump. It's still pretty fragile. You know, it's not reacting hugely to that big volume. And even more so, if you get another lump comes through immediately after it in the same direction, or adding in the same weight. Excuse me for one moment. Just going to switch off for a moment. Hold on. I had a frog in my throat. Sorry about that. So you're looking at that as well all the time. Thanks, darling. Sorry, bear with me a moment. Sorry about that. So we're looking for reaction. We've got the buying coming in here. We've got this big volatility candle. We're expecting something to happen, and it just tells you what is going on down the right-hand side here. You know, 2 bars ago on 5-minute. Just click on the 5-minute. There we go. So on the 5-minute, we know 2 bars ago, there it is. We had a big volatility candle. So we don't need to have multiple charts. We can just zip through here, up and down. We can see what's going on in terms of volatility triggers and picking up those opportunities. So we're looking for either congestion or we're looking for reversal. And given the weight of volume that just went through on the time of sales window, no great surprise to see that market react to the volume that's going through. Yen is still climbing. It's not climbing fast, but it is still climbing. If it comes to a standstill or reverses, and obviously that will help to push this higher, but for the time being, we're just sat within the reversal candle or the possible congestion candle of the 5-minute time frame. So it gives you a great visual picture, this one workspace where you've got literally everything you could possibly want with regard, and you can obviously put more things on here. I could cram some more indicators on here up on radar screen. This radar screen on TradeStation Global takes 450, I think it is, different time frames, and on TradeStation Securities you can go up to 1,000. So if you're analyzing stocks, it's really powerful because you can set it up in such a way that you can pick things off literally in real time. So that's where we are in terms of TradeStation Global. Let's just drop that out of the way. This is on, let's just go over onto the multiple of the indices. There we go. So we're seeing the same thing here. The top line, I've got 5-minute. This is on the YM, the NQ, and the ES. I know some of you have seen this before. Down on the bottom here, we've got the daily time frames. And really, this is what is causing the angst, the nervousness. You can see it here. We've got some minor resistance building here. This little red dashed line, it's minor. It's not particularly strong, but the mere fact that you've got this sort of price behavior, it's very narrow, it's very thin, it's not demonstrable, it's indecisive, it's fragile, and you can imagine this just rolling over and going all the way back down to the VPOC here. I'm not suggesting that it will, but that's what you're actually seeing. We had more volume going yesterday, not huge, more indecision. Now we're trading in this very narrow range at the moment. We'll see how the volume shapes up at the end of the day. But that's what we're seeing in terms of the daily time frame. It's not quite so pronounced on the YM and the daily, but nevertheless, it is still, yesterday's candle tried to rally and failed, reasonable amount of volume going in there. So there's effort going in, but it's just not getting anywhere. This was a classic sign up here, big telegraph pole at the top of the hill. You're always looking for that one. Well, yeah, you're going to get a reaction. On this occasion, it rolled over the following day with lots of volume and followed through the day after as well. And then we saw the buying coming back in again. But it is very weak. That's where we are at the moment. And in terms of the ES, similar sort of picture there as well. You've got this price action that's rolling over. It's not, we're not going upwards, we're going sideways now, and we're starting to create a bit of a curve to the downside. There is a strong platform in terms of the ES. We've got a very strong price-based platform in here at 6. So there is some decent price-based support there. But if we break down anywhere near to this region here, we've got low volume, it's going to go through there like a knife through butter. So a hot knife through butter at any rate. But from an intraday perspective, it's completely different ball game. You're looking at the opportunities. You've got a 2-bar reversal here. You've got lots of volume coming in under that one. A little bit of support coming in here as well. Now, in terms of where the market is going to go, what have we got in the way? Well, there's 26 different things in the way. We've got heaps of volume in this area here, going all the way back up to the VPOC. So it's a real struggle to get through there. So we've got volume-based resistance ahead of us. We've got price-based resistance here, which looks as though it might be taken out with this candle. We'll have to wait and see. Then we've got an even stronger level up here, this red dash line, and we've got a cluster bit above it as well. So there's a whole raft of price race reasons here, which were developed around here. The market tried to retest through there and failed, now rolled over, now trying to come back again. So there's all sorts of reasons. And the expectation is, how far is this going to go? If it did rally, well, assuming it didn't stop here, which it almost certainly would at some point, if only for a short period, the next stopping point is going to be up towards the volume point of control itself. But as I say, from an intraday perspective, let's go to the multiples. I'm not quite sure. I think I've got the YM on the multiples. There we go. Perfectly tradable. This is 15 seconds. You've seen it before, I'm sure. Perfectly tradable, indicators working exactly the same way. Trend monitor there, bright blue, picked up that little rally, very nice, through that low volume area, gone through that pretty quickly. That's what you're looking for on the VPOC the whole time. You're looking at high volume nodes, low volume nodes. On this time frame, we're on the 1 minute here. Ton of volume coming in under this candle here, massive amount of volume. We've had the rally. How far is it going to go? Again, you know, you've got a channel here. You will often see this with the accumulation distribution indicator and around the volume point of control. Why? Because it's channeling around the fulcrum of the market is the yellow dashed line at that point. At this point, price was in agreement. In other words, there was no strong bias one way or the other. And in an extended congestion phase, what you're obviously going to get is you're going to get repeated tests above and below. And that then builds into this channel. It's almost a perfect channel, which is centered around the volume point of control. So you have the VPOC at the middle, and then you have a resistance area above and a platform of support below. And it's just a terrific place to find trends developing, because if you can wait and be patient, this is on 1 minute, it could be 5 minutes, it could be 15 seconds, it could be a daily. But if you're prepared to wait and be patient, they are terrific places to set your stall out and pick off either breaks to the upside or the downside, because when they occur, as indeed they did here, it is so clear where to set any stop loss. But moreover, you've also got this huge wedge of price-based protection and volume-based protection, which is going to protect you if the market pulls back against you. So if you jump in short, fine, no problem at all. Your stop loss will be above this lot, somewhere up here. Maybe you know, depending on your risk and money management rules, ideally it should be above all three. But if you can't, then it's got to be in here somewhere. But ideally it should be up here somewhere. And then once you've got your stop loss in place, you've got this massive amount of natural protection in the way. This is like it's like a wall, really. It's you know, it's not impenetrable. Of course, it's not impenetrable, but it is pretty solid, because for the market to get through that, it's going to take a huge amount of effort. So you've always got that protection. So it's just, you know, trading from congestion phases. If you're a patient trader and you have that in your psyche, then it's a great way to you know, take a tactic to market. It doesn't suit everybody. Some people are impatient. They want to be trading, you know, 500 times a day. Well, you know, that's fine. You have to find what works for you. But I'm just saying, from a trading perspective, it's hard to beat, to be honest. If you can find the patience to dig these out and wait for them in whatever time frame. This is 1 minute, so it doesn't have to be, you know, you don't have to be sitting there hours and waiting for something to develop. It can be on 1 minute, 15 second, 2 minutes, 3 minute, whatever. Once you get this channeling effect, and then you start to get the breakaway, as long as it's confirmed with volume, absolutely fine. And then you're looking below. What have I got below? What have I got in terms of price-based support, which is like to come into play? What have I got in terms of volume that's like to come into play, et cetera, et cetera, et cetera. It's just a great way to trade, but you have to be patient to do it. This is trying to rally, go down onto 5, and then you start to go down onto the other time frames. You're looking from 1, 3 down to 5. What have we got in the way? We've got some very strong price-based resistance here, another layer up here, and obviously got the volume point of control here, and a huge amount of volume here. So for this to drive through here, this looks pretty weedy. We've had an effort to rally, got a wick to the upper body, not a great deal of interest to the upside at the moment. You know, it's not looking particularly strong for a rally move. The yen, in addition to that, has just hopped up again over on, just pull this over so you can see it here rather than me rabbiting on. This is the yen, remember. So this is what's happening on the yen on 5 minute. That's where it's going, and clearly it's coming up to a top, which we've seen earlier in the day. So if this is going to continue on, then, you know, this is a key area. If we get through here, then you know, it looks as though we're going to see more yen buying, and if we see more yen buying, then we're going to see further selling of risk assets. Let me just go on to commodities very quickly. Anna was talking about commodities. Oil is starting to break out. We did a post on this earlier in the week. This is what oil is up to. Another key level was breached. $65, $66 a barrel was one we wrote about repeatedly. This is on the weekly chart, remember. We've written about this repeatedly over the last few months. And finally, today, sorry, not today, but in the last few days, just change this over to daily. It's actually broken out. It's broken out in decent volume. It's moving up to the top of the chart, so we're moving up into a low volume region. It's up at 68.82, and I think at the time we wrote 67 something. So that's where we're seeing with oil. So it's through a key area, and oil looks as though it is set to move higher as well, as indeed are some of the other commodities. Just check out gold, bullish on gold. Similar sort of picture on gold. It's been trending upwards. It's got to this level. It's through 1900. That was a key level to get through. We're looking for it to go possibly all the way up to certainly 1920, 1950. Whether it'll get to 2000 or not, I don't know. The key will be inflation, because if inflation does take hold, and let's face it, in fact, Ezzy mentioned the fact about shipping costs. Inflation covers everything, and when you think about food, it's not just the cost of food, it's the cost of transportation. And as he says, the cost of transportation is rising. You only have to look at the Baltic Dry Index, and that will give you an indication of shipping costs, and they've been rising steadily, which is no great surprise. Everything is rising at the moment, and that is all played out in terms of inflation. It all plays in. You know, it's not just about growing whatever it is, it's about getting it from A to B and all the rest of it. Just pull that up on soft commodities, and then I'll pass back to Anna very quickly. This is soybean, corn, and wheat. Big run up. We've had a sell-off recently, but it's starting to revert back to bullish again. And you know, that, as far as we're concerned, that is continuing the uptrend. Same on corn, and the same on wheat as well. Although they've all had this pullback, but it's still pretty bullish. And that's the uptrend in commodities, which is pretty universal. And you've seen in a lot of other things as well, in base commodities too. The price is rising pretty dramatically. Let's have a quick check on stocks. This was an interesting one. This was COG, which again, you can find the post on Anna's site that we wrote about this one. And what was interesting about this one was this big reaction here of, when was it, a couple of weeks ago, I think, was a merger between this company and another on a, was it potentially, it's got to be approved, but it was on a like-for-like basis. So it was just a straight 50-50 merger, if you will. Huge reaction, ton of volume coming in, big volatility candle, and you know, the outcome is as we have expected. What's interesting about it, this is on the daily, you can see the amount, the selling pressure has diminished. And one of the things you're always looking for in volume price analysis on any chart is where you see price action within a range where you've seen high volume, and now you're seeing a reduction in that volume, particularly in downtrends where you see, for example, this, we've had heavy selling in that price range, we had more heavy selling in here, and now we've got the same, the price is still moving within the general range of that price action, but the volume has declined dramatically. So what does that tell you? It tells you that that massive selling pressure that was evident earlier in the phase of the cycle has now diminished, and therefore what we expect to see is a rally in this particular stock. We don't know how far it's going to go. It's got an awful lot of volume to get through in terms of this particular range. We're going to get up to this level where we've got price-based resistance as well, very strong price-based resistance. But basically the point we made was, from an investment point of view, and obviously we were looking at this from a weekly and a longer term perspective, you know, this is not a bad stock to be considering. But then the point we made was, what you're looking for here is the accumulation of buying which is coming in, basically the market makers stepping in, accumulating the volume, buying into this big price waterfall, absorbing the volume, and ultimately at some point you will then start to see a reaction higher. It's a classic. This is not a classic example of a saucer, but some of the price action that you look for when you're looking for longer term investments, and it's one of the things we used to do many years ago when we were doing it manually by eye. We used to go through something like 3,000 or 4,000 charts in a night, and you think, how can you do that? It's pretty easy actually, because what you're looking for is a particular shape, a chart on whatever time frame. We used to look at the dailies. And particularly you're looking for what we used to call a saucer shape. In other words, where the price action has declined quite dramatically, has flattened out into a congestion phase, and is now starting to bottom out and come out the other side. So you get this lovely sort of saucer shape. and it's indicative of accumulation. So it's essentially what's happened. Obviously, you've had a lot of selling. The market makers have stepped in, accumulated over a long period, and are now developing the next phase of a campaign to actually take that market back higher again. And it's just a very classical pattern. This is not a saucer, but it's indicative of the sort of thing you're looking for, where you see heavy selling, you see the market maker stepping, absorbing the pressure. And this is the analogy we've used hundreds of times before, is the oil tanker. If you turn the engines off an oil tanker, it will carry on for many miles under its own momentum. And that is exactly the same in the market. That momentum that's been developed, particularly in price waterfalls, has to be absorbed. And even the market makers, with all their muscle and might, have a bit of a job absorbing all that buying pressure. So it takes time. It's like mopping up. It's a sponge mopping up a spill. You can't do it in one pass. It takes 3, 4, 5 passes to dry it out completely. It's exactly the same principle here. So it's a really interesting stock, that one. Let me pass back to Anna. By the way, the yen is jumping up quite dramatically now. Where will you find all the bits and pieces? You'll find them here this is where you'll find all the indicators at quantumtrading.com. We have all the platforms, MT45, NinjaTrader 7.8, TradingView, which I've just been through with you, and also TradeStation has now been launched. We've got 2 versions of that. That's the TradeStation 9.5 with interactive brokers as the live feed, and TradeStation 10, which is TradeStation Securities, and they of course incorporate the awesome power of radar screen, which is wonderful. And remember, when you invest with us, there's several things to remember. First of all, you can move your indicators from platform to platform. So if you start with one platform, you perhaps want to move to another platform, that's perfectly fine. We don't charge you for that. We just transfer your indicators across. We have a lot of customers who start perhaps with MT4 or TradingView, then they want to move to TradeStation or NinjaTrader. Perfectly fine, we do that for you, absolutely no charge at all. And finally, if you do, whether you buy one indicator or several, if you upgrade to another package, for example, we will always give you a credit for those indicators. So you never lose out, you never lose your initial investment. We always protect you in that respect. So you'll always receive a full credit. And finally, of course, if you invest in the full package, even more so with TradeStation at the moment, because it's currently at $677, I think off the top of my head. But once those other indicators are developed for the platform, then we will be increasing the price, which will align with the MT45 platform. So it's a great time to invest with TradingView, because as I say, you'll get all those indicators free of charge. You won't be paying for them. So it's not a bad time to invest in that package. But all the other packages, if you invest with a full package, we also give you all future indicators we develop free of charge. It's just our way of saying thank you. Finally, just to give you a heads up on the education program, I've just touched on 1 or 2 aspects of it. Obviously, within the program here, it's called the Complete Forex Trading Program because that's exactly what it is. To say it's comprehensive is a disservice. It is everything you need to know. You have all the modules which cover the psychology, the fundamental analysis, relational analysis, so you'll understand how markets relate to one another in terms of risk, in terms of relationships to bonds, bond yields, how commodities fit into that structure, and of course the actual relationships within markets, how currency pairs relate within the markets themselves. You've got a deep dive into technical analysis, of course, that is VPA. It's all the Wyckoffean principles, it's Wyckoff's 3 laws. And in addition to that, it's how to apply VPA, not just to straightforward analysis, but we teach you how to understand when a trend is coming to a pause point and to identify whether it's actually a reversal in trend, in other words, from primary to primary, or is it simply a pullback? And if there's one thing that you would learn, it is simply that, because that will stop you getting out of trades too early. It's as simple as that. The mechanics of trading, and then there's something like 200 to 300 hours of video, VPA chart examples, how to use the indicators, pulling it all together, topic webinars with Anna and myself, a huge webinar library, and a resources section as well. And of course, all of that is backed up now. We've added the QTE funded Forex program. And the reason we've done it is very simple, because we wanted to give you, our students, and this is only available to students on the program. I'm sorry, it's not available to anyone else. If you're a student on the program, you have the option to join. It's there to give you the opportunity to leverage your knowledge. And it's very simple in the way it works. It's a no risk deal as far as you're concerned, because you are trading our money. It's as simple as that. We give you the opportunity to start with an evaluation account at $5,000, $10,000, or $15,000. Once you've achieved a very achievable target at that level, you've proved to yourself that you have the consistency to trade, you've proved to us you have the consistency to trade, we then multiply it by 4. So if you start with a $15,000 account, we push you up to 60,000, and thereafter we double it. So you go from 60 to 120 to 240, and in pretty much no time at all, you would be up trading $1 and $2 million accounts. It is simple as that. There is no risk to you. There's a one-off fee to pay. That's it. That's your only expense of getting into that particular program, but it's entirely optional. What we've now bolted together, we feel it gives the complete package, if you like, of giving you the opportunity as a student to benefit from your knowledge and prove to yourself that you can trade a large money account at no risk. So that's it. Hope you've enjoyed this particular video. Lots more to come as always. Thanks for watching. See you again soon, and bye for now. Where will you find all the bits and pieces? You'll find them here this is where you'll find all the indicators at quantumtrading.com. We have all the platforms, MT45, NinjaTrader 7.8, TradingView, which I've just been through with you, and also TradeStation has now been launched. We've got 2 versions of that. That's the TradeStation 9.5 with interactive brokers as the live feed, and TradeStation 10, which is TradeStation Securities, and they of course incorporate the awesome power of radar screen, which is wonderful. And remember, when you invest with us, there's several things to remember. First of all, you can move your indicators from platform to platform. So if you start with one platform, you perhaps want to move to another platform, that's perfectly fine. We don't charge you for that. We just transfer your indicators across. We have a lot of customers who start perhaps with MT4 or TradingView, then they want to move to TradeStation or NinjaTrader. Perfectly fine, we do that for you, absolutely no charge at all. And finally, if you do, whether you buy one indicator or several, if you upgrade to another package, for example, we will always give you a credit for those indicators. So you never lose out, you never lose your initial investment. We always protect you in that respect. So you'll always receive a full credit. And finally, of course, if you invest in the full package, even more so with TradeStation at the moment, because it's currently at $677, I think off the top of my head. But once those other indicators are developed for the platform, then we will be increasing the price, which will align with the MT45 platform. So it's a great time to invest with TradingView, because as I say, you'll get all those indicators free of charge. You won't be paying for them. So it's not a bad time to invest in that package. But all the other packages, if you invest with the full package, we also give you all future indicators we develop free of charge. It's just our way of saying thank you. Finally, just to give you a heads up on the education program, I've just touched on one or two aspects of it. Obviously, within the program here, it's called the Complete Forex Trading Program because that's exactly what it is. To say it's comprehensive is a disservice. It is everything you need to know. You have all the modules which cover the psychology, the fundamental analysis, relational analysis, so you'll understand how markets relate to one another in terms of risk, in terms of relationships to bonds, bond yields, how commodities fit into that structure, and of course the actual relationships within markets, you know, how currency pairs relate within the markets themselves. You've got a deep dive into technical analysis, of course, that is VPA. It's all the Wyckoffean principles, it's Wyckoff's three laws. And in addition to that, it's how to apply VPA, not just to straightforward analysis, but we teach you how to understand when a trend is coming to a pause point and to identify whether it's actually a reversal in trend, in other words, from primary to primary, or is it simply a pullback? And if there's one thing that you would learn, it is simply that, because that will stop you getting out of trades too early. It's as simple as that. The mechanics of trading, and then there's something like 200 to 300 hours of video, VPA chart examples, how to use the indicators, pulling it all together, topic webinars with Anna and myself, a huge webinar library and a resources section as well. And of course, all of that is backed up now. We've added the QTE funded Forex program. And the reason we've done it is very simple, because we wanted to give you, our students, and this is only available to students on the program. I'm sorry, it's not available to anyone else. If you're a student on the program, you have the option to join. It's there to give you the opportunity to leverage your knowledge. And it's very simple in the way it works. It's a no risk deal as far as you're concerned, because you are trading our money. It's as simple as that. We give you the opportunity to start with an evaluation account at $5,000, $10,000, or $15,000. Once you've achieved a very achievable target at that level, you've proved to yourself that you have the consistency to trade, you've proved to us you have the consistency to trade, we then multiply it by 4. So if you start with a $15,000 account, we push you up to 60,000, and thereafter we double it. So you go from 60 to 120 to 240, and in pretty much no time at all, you would be up trading $1 and $2 million accounts. It is simple as that. There is no risk to you. There's a one-off fee to pay. That's it. That's your only expense of getting into that particular program, but it's entirely optional. What we've now bolted together, we feel it gives the complete package, if you like, of giving you the opportunity as a student to benefit from your knowledge and prove to yourself that you can trade a large money account at no risk. So that's it. Hope you've enjoyed this particular video. Lots more to come as always. Thanks for watching. See you again soon, and bye for now.